Hello and welcome to the Kingsview Investment Strategies 2017 Investment Review and 2018 Market Outlook. My name is Scott Martin, Chief Investment Officer at Kingsview Asset Management, and joining me today, Paul Nolte, Portfolio Manager and Senior Vice President of Kingsview Asset Management. Paul, thanks for joining me today, taking some time to talk about the year that was, and maybe the year that wasn't to some degree, and also look forward to 2018 with respect to how we're positioning our portfolios at Kingsview Investment Strategies, as well as, I think, highlighting some of the interesting topics that are, say, circulating about with respect to the markets. One thing that I liked about what you write, and you write an often commentary about the markets and some of our investment portfolios, one thing I really liked, Paul, that you wrote about in 2017 was this idea of the performance of the markets, and certainly mainly equity markets, but maybe bond markets too, because they were largely positive, being a gift to investors. Tell me a little bit more about what you were thinking in that explanation.
You know, what's kind of interesting is when we came into the year, Trump had just been elected. The inauguration was still 3 weeks away. There was a lot of concern about changes that were going to be happening in the U.S. market. Brexit was 6 months behind us. The Fed was already on the table to raise rates at least a couple different times. So coming into the year, there was an awful lot of headwinds, a lot of uncertainty about what was going to be happening in the markets. We saw energy prices pick up here a little bit. So to see the markets put in double-digit, 20, 25% rates of return, emerging markets up 30, and even the fixed income market put in a positive rate of return for the year was really kind of stunning when you look back at how we came into 2017. We came in rather pessimistic, a lot of uncertainty. We came out of the year smelling like roses and looking for a fabulous 2018.
I was thinking the same thing, maybe even better than roses, if there is such a thing, smelling better than a rose. And similar to that uncertainty was the economic backdrop, which was the worrisome that D.C. was going to screw everything up, Congress wasn't going to get anything done, but then we finished the year with another million or so jobs created, GDP that's looking at steadily, dare I say, above 3%, wage growth that's coming back now at, say, 3.5% or so, 3-month average rolling growth. So those data points, too, started to perk up alongside, like you said, the market, which was strong the whole year.
And the economy did a fine job all year. It really wasn't any big surprises on the upside. There really wasn't any big surprises on the downside. So when you look at the Economic Surprise Index, finished the year at a multi-year high. So certainly the economy was performing a lot better than economists thought. The one part that is still confusing a lot of people and having problems with is inflation. We're really not seeing the inflation that we anticipated with unemployment as low as it is, with manufacturing starting to pick up, the dollar being weak. We would have expected inflation to pick up. And that's the one part that really has gotten everybody kind of confused right now.
I wonder if that's the black swan that swims up at some point. But like you said, maybe it's already swam by us a few times because everybody's been looking for inflation that's nowhere to be found. Talk to me about market valuations. You know, in the portfolios that we run together through the multi-strat portfolios or the AAA that are available in the Kingsview Investment Strategy Suite. Talk to me about, Paul, how you're seeing valuations in the market, because depending on how you look at it these days, valuations can be, I guess, good, overvalued, bad, you know, and so tell me about where kind of valuations are and what maybe a best way is to look at them vis-a-vis earnings that are out there.
Yeah, one of the things that we take a look at is we look at the S&P 500 and we take a look at the best earnings year for the S&P 500, which actually is this year. And based on this year's earnings, 2017, the end of the year earnings, you're looking at a market that is about a 20 multiple on the S&P 500, and it puts it in the top 5% of historical ranges. Even more so is the small cap. Small cap universe is in the mid-20s, upper 20 PEs. So the U.S. markets are very expensive. When you look around the world, though, emerging markets, international, the EFA index, those are much cheaper. So those international markets are playing catch-up, or probably are going to be playing catch-up to the U.S. markets. So from our way of looking at, my way of looking at things, international probably a little bit better place to be right now than the domestic market. Again, playing that catch-up.
Well, you mentioned, the catch-up, and let's cut right to the mustard, if I will. Look at some of these numbers. I mean, MSCI index in emerging markets up 34.2% in 2017. MSCI developed markets, this is ex-US, as you pointed out earlier, up about 24.8% on the year. I mean, need I say more? US large cap, so that's S&P 500, up 22.3% total return. And then we mentioned bonds earlier, touched on them, but just another area where you didn't have to be so scared of your bonds. Maybe going into 2018, which we'll talk about in a second, you need to be be more worrisome about bonds. But goodness, 2017 in the 10-year Treasury, total return 2.25, not too bad. Yes, maybe a volatile ride, more of a volatile ride than you wanted, but not too bad. High yield corporate bonds were up just a scotch over 5%. High grade corporate up about the same, maybe a little higher than 5%. Again, total return numbers, not bad to finish the year considering all the uncertainty we put out there. So let's talk about 2018. I mean, some of the major themes I think going forward in my mind, Paul, and as we've kind of positioned the portfolios in the multi-strat, the AAA, the ProCap, the Sector Alpha, all the portfolios that are available through the Kingsview Investment Strategy Suite. Some of the major things we've been concentrating on have been maybe global growth coming back. I mean, the World Bank, whether you give them any credit or not, World Bank, IMF, I'm not sure if you trust those guys or gals, but the World Bank says global growth at about 3.5%. We got pretty much close to, in my opinion, full employment in the U.S. GDP growth, which looks like it's going to be solidly above 3%, maybe 3.5% in Q1 of 2018. Talk to me about some of those data points.
Well, and you talk about the ISM, both service, manufacturing, the unemployment rates. Everything is already lined up. So if you want to look at what could possibly go wrong, everything is hitting. So you're saying, well,
so that means everything could go wrong.
It's already in the market. So when you say, well, what's the market anticipating? They got the tax legislation they wanted. They've got manufacturing doing well. They've got the economy humming. Global economy is humming as well. You look at all of the economic data from a lot of the foreign countries. All of them are in expansionary phase. So investors already know that, and it's already getting priced in the market. And part of the reason why the markets are probably as expensive as they are. So given the momentum that we're seeing coming off of 2017, best guess would be first quarter certainly, but maybe first half of the year looks pretty good. Then we start worrying about
I worry
maybe
about
the
that.
back half.
I like how you put that. I worry about consensus view because, like you said, it's already in the market. Like consensus is the easy one.
Right.
And you don't usually want to be that way, or as you've seen in times when the market gets dislocated, we have black swan events. The time when you're not with consensus there is when you stand out. And one thing I will say on top of that consensus view you mentioned, Paul, is let's talk about the new Fed. Jerome Powell coming in as we tape this. This is about mid-January. Jerome Powell's coming into the Fed next month in February. New chairmanship has talked about kind of continuing the easy money of Janet Yellen, but maybe raising rates maybe a little bit quicker than, say, the previous Fed chairmanship did. And therefore, what do you think about the Fed being as far as consensus and how maybe they can throw something off with respect to hiking rates a little bit faster?
What's interesting is Janet Yellen is one of the only Fed chiefs that has come into that position and not messed up monetary policy. So Bernanke raised too quickly. Greenspan raised very quickly, and some would argue caused the '87 crash. That was his inauguration into the Fed. Even Paul Volcker did the same thing. So the concern is that Jay Powell raises rates too much, too fast, and the Fed historically will do that to the point that something breaks.
Yes, and speaking of something that broke, and breaking news kind of in the late, I guess, hours, it felt like, of 2017, was the tax cuts. Can you believe? I mean, I'm actually shocked they finally got something through. You and I, you're on Bloomberg and Fox and CNBC and talking about a lot of economic-related events, just like myself on Fox. And one of the things that I was sure that wasn't going to happen was this tax cut finally getting through. It just seemed like there was going to be too much political wrangling and too much political theater to finally get something done, and they got it done. So talk about maybe the tax cuts coming through, mainly on the corporate side. The individual side's a little bit wonky, if you ask me, as to how beneficial it's going to be. But goodness, the corporate side cutting to 21%, it's got to look pretty good.
Well, what's interesting is the timing of it. It comes so late in the economic cycle. This would have been a great thing to have in 2009, 2010, or 11 when you really want to get the economy going. Right now, you're really fighting against monetary policy, and going back to Jay Powell, that may give them more reason to raise rates a little bit quicker because they're getting all of the stimulus coming in. But when we look at it from an earnings perspective on the S&P 500, then you're going to get this one-time pop of earnings this year. What you probably won't get is that continued pop year after year after year. So it's a one-time bonus, if you will, but it's not anything that we think is going to carry forward and provide additional long-term growth.
I mean, I think other than maybe some additional volatility, which pretty much disappeared in 2017, I mean, we had 8 days in 2017 that moved up or down 1%. 8 days. And that was in a market that, as we talked about, moved wildly to the upside. And if you look back at how volatile have other markets been, if you look at, say, 2016, 2015, you had, say, 35, 45, 50 days, somewhere around there for those 2 years that went up or down 1%. And last year, again, just 8 days, sports fans, went up or down 1%. I mean, it's unbelievable. So given that and our outlook kind of and how we positioned everything at Kingsview Investment Strategies and your portfolios for 2018, we're expecting more volatility. We're expecting to be, needing to be, let's say, more nimble and certainly more attentive to economic events out of the Fed. Anything else you can think of with respect to how we're kind of looking at things and how we've maybe changed or started to think about altering the portfolios from 2017?
Well, kind of going back to the gift that we got in 2017, really, from an investor's perspective, everybody is looking at, I need to get more money in the market. Look, it's going up. So you get into this positive market cycle. Why is stocks going up? Because more people are buying. Well, why are people buying? Because stocks are going up. We're in that cycle right now, and so we've started to take a little bit of money off the table. We did a little bit in the fourth quarter. We will probably do it again, reposition the portfolio a little bit. And when you look at it at the time, it looks like the wrong thing to be doing. But really, when you've gotten that type of rate of return, you want to take some of those dollars off the table because the market will go down at some point.
More appropriate valuation, right?
And a more appropriate valuation. I don't know when. I'm looking at from 3 to 5 years, we could see the market down 30%.
And the data, sure, and the data would tell us that. So we're doing some risk management tactics here for you because we believe that it's important to live to fight the next day, so to speak, or bring the toys to the next party, so to speak, and not lose them all. So with that said, we really appreciate you joining us for the Kingsview Investment Strategies 2017 review and 2018 outlook. Paul, thanks to you for joining me, sir.
Absolutely.
And if you need to reach us, by the way, we're in the Chicago office. You can reach us we have an email that gets to everybody on the investment committee, Paul and I, and some of our other folks, our analysts, our traders, and so forth. If you'd like to reach us for more information with respect to fact cards, information on the portfolios, and even some information on more detail on things we talked about today, you can reach us at IC@kingsviewam.com. We look forward to hearing from you guys. Thanks.
Thank you.